In this video, I present the principles of growth accounting. The questions with which we start are how we can decompose economic growth into the contribution of the components of the production function, so how much of growth is explained by the accumulation of physical capital, human capital, and raw labor. And the second question is whether we can use this methodology to derive a measure for productivity growth, which is actually the only component that we cannot really measure. As an illustration of the basics of growth accounting, we start with our standard concept of the production function. So we assume that output of a certain country at time t can be explained by the different components, physical capital, human capital, productivity, and so on. And we know already that the production function is typically concave. So if we increase one of the inputs, then this leads to an increase in output, but at a decreasing rate. Now assume we observe country I at time t, and it has a per capita GDP of yt. Then we observe the country again at some future date, t plus 1. And what is illustrated in this picture is that in this country, input factors increase. So if this is, say, physical capital, the country then uses more physical capital at time t plus 1 than at time t. The input could also be labor or human capital or one of these accumulable production factors. This would then mean that the country moves along its production function to a higher level of output per capita at time t plus 1 because it uses more inputs. The production function itself did not change here. So just the inputs change, and therefore the country moves along the production function to a higher output level. Now let's assume, for the sake of illustration, that something else happened between time t and t plus 1, namely the production factors did not change at all, but productivity increased in country I. What would happen then? We would have a shift of the production function. So if we have a productivity increase, then the production function would shift counterclockwise here, and we would get to a higher output level at time t plus 1, but for the same input level. So productivity increased with the same inputs, I can produce more. What will typically happen in reality, however, is that both things change. So a country will accumulate production factors, human capital, physical capital, and at the same time productivity would change, typically increase, so that the country would then end up at time t plus 1 with a higher per capita GDP, and one part is explained by more physical capital and more human capital. So one part is explained by factor accumulation. And another part of this increase in YT is explained by productivity increases. And what we want to do with growth accounting is decompose the increase in per capita GDP between time t and time t plus 1 into its components. The increase in accumulable production factors that we can further decompose into accumulation of physical capital, accumulation of human capital, and into increases in productivity. Now we formalize this idea. And to do this, we start with the standard production function framework that we usually use throughout this course, where we have output, and output is produced with physical capital with an output elasticity of alpha, and human capital with an output elasticity of 1 minus alpha, where human capital is the product of individual human capital or average human capital with the number of workers that are employed in the economy. So that's the human capital stock in production. And we multiply this Cobb-Douglas expression with productivity. So if productivity increases, we would be able to produce more. And if production factors increase, we would also be able to produce more, but at the corresponding diminishing marginal products. Now we use the trick that it is easier to compute the growth rate of this because that's the change in y, and that's what we want to decompose by taking the logarithm and then the time derivative of the logarithm. That leads the growth rate, and it's usually easier to compute than taking the time derivative first and then dividing by the level, which would be the definition of the growth rate. But we see here we would have to apply the chain rule and the product rule and so on, and the expressions can become quite cumbersome. If we take the logarithm first, we get the logarithm of output is the logarithm of productivity plus alpha times the logarithm of physical capital input plus 1 minus alpha times the logarithm of individual human capital plus the logarithm of the number of workers. So that's easily done. And if we take the time derivative afterwards, that's also easily done. We get the growth rate of output on the left-hand side, which is then the sum of the growth rate of productivity plus alpha, that's the output elasticity of physical capital times the growth rate of physical capital in production, plus 1 minus alpha, the output elasticity of human capital, multiplied by the growth rate of individual human capital plus the growth rate of the population. So we have now decomposed growth of output into its components, growth of productivity plus growth of physical capital plus growth of human capital, basically. For convenience, I state the equation again here, where we see that growth of aggregate GDP or aggregate output is basically the weighted sum of the growth rate of inputs in the production function and of productivity, right? And the weights are the elasticities of output with respect to the corresponding input factors, and productivity growth has a weight of 1 because the exponent is equal to 1. Now we can actually plug in the growth rates that we observe empirically. So what we know is that alpha would be approximately 1/3 in the US, the long run average until the 1970s. So we plug in 1/3. And now let's just assume some growth rates for the sake of illustration. Let's say productivity growth is 1%, growth of physical capital is 3%, growth of individual human capital 1.5%, and growth of the workforce is 1.5% between time t and time t plus 1. Then the growth rate of aggregate output would be 1%, that's the growth rate of productivity, plus 1/3, that's alpha, times the 3%, which is the growth rate of physical capital, plus 2/3, that's this 1 minus alpha, times the growth rate of individual human capital plus the growth rate of the workers, the number of workers. And that's then the sum of 1.5 and 1.5 is 3%. And if we compute this, we get aggregate GDP growth of 4%. So what we've done up to now is to decompose output growth into its components. So we've answered the first question that we posed at the beginning of this chapter. However, there is a complication, and that is that typically we can only measure, and even that imperfectly, growth in output, growth in physical capital, growth in individual education that we can translate into individual human capital growth, and growth in the number of workers. But what we cannot measure, or what is notoriously difficult to measure, is growth in productivity. Now we can use our decomposition from before to get an indirect measure for productivity growth. So we can derive it as a residual from all the other components that we know. So what we do is we reformulate equation 1 and bring productivity growth to the left-hand side. What we would then have is productivity growth as the difference between aggregate output growth and the contribution that we have to aggregate output growth from the accumulation of production factors, physical capital, human capital, and labor. Then we can derive growth in productivity as a residual measure. So if we plug in the same numbers that we had from before, we had productivity growth of 4%, which we calculated, then physical capital growth of 3%, we have 1/3 of that we have to subtract from the 4%, and then we have to subtract 2/3, so 1 minus alpha times 3%, and what we get in the end is 1%. So we would have productivity growth with the numbers that we had before of 1% in this case, that aggregate output grows with 4%, and we assume that productivity growth is unknown. So we can recalculate productivity growth, or it's often called TFP growth, total factor productivity growth, or the Solow residual, or our measure of ignorance, because it basically comprises everything that we cannot explain by the stuff that we observe. So it contains technological progress, it contains improvements in institutions, and so on and so forth. Usually we are interested in GDP per capita growth and not in aggregate output growth, But there, the method doesn't change. So we just work with lowercase y, so per capita GDP, which would be, according to our formulation, productivity times physical capital per worker to the power of alpha, and human capital per worker, which is average human capital, to the power of 1 minus alpha. If we take again the logarithm and time differentiate afterwards, we would get that growth in per capita GDP is growth in productivity plus alpha times growth in the capital intensity plus 1 minus alpha of growth in human capital intensity, if you will. And then you can easily check also that actually per capita GDP growth is just the difference between growth of aggregate output and growth in the number of workers. And growth in the capital intensity is growth in aggregate capital minus growth in the number of workers. So everything is internally consistent here. So overall, to summarize, we were able to derive a decomposition for aggregate output growth into its components. So answer the first question that we posed at the beginning of the chapter. And second, we were able to use this decomposition to get an indirect measure for productivity growth as the part of aggregate output growth that is not explained by growth in the accumulable production factors, physical capital, human capital, and the number of workers, basically. And that answers the second question that we posed at the beginning. Now, at the end of this chapter, a few comments are in order. First of all, early research using growth accounting, such as Robert Solow, they found a very large part of output growth is actually explained by productivity growth, and only a comparatively small part by what we can measure, which was mainly at that time physical capital accumulation. Now, the share that is explained by productivity growth, or basically our measure of ignorance, so what we cannot measure, decreased a bit because we got better in measuring some of the inputs, and we also included human capital instead of only physical capital and so on. But still, nowadays, also a large part of aggregate growth is explained by productivity growth. In high income countries, the share is even larger. So in high income countries, a larger share of total output growth can be explained by productivity growth than in low income countries, where factor accumulation is, in comparison to high income countries, a bit more important, basically. And then one caveat at the end. So often productivity growth is shown in some models to be the driver of factor accumulation. So if productivity growth increases, that induces accumulation of physical capital, and that induces people to educate themselves better, and so on and so forth. So it's important actually to know that what we've seen here was only the direct contribution of these different components. It was not considering that the components themselves might be driven by productivity growth. So that's a question of direct versus indirect effects. If one takes into account these indirect effects, one would see that actually an even larger share of total growth is explained eventually by productivity growth.